Welcome to Investors Insights. Our topic today is inflation Grinch. We chose that topic because of the discussions we're having with our clients and phone calls and in-person meetings, Zoom meetings, in regards to where they're saying, do you understand how much Christmas and the holidays are costing me? I think things have gone up in cost. And so we want to address that because inflation has become a hot topic. And we don't want it to take away from your holiday spirits this year. So addressing the inflation Grinch, I've got my distinguished colleague, Bobby Norman, talking about the uncertainties in the market and backing it up with facts. I've got Ty Miller talking to us about the jobs report that had an impact last week, and do we need to be concerned? I've got Trey Booth with me here that's going to be really focusing on inflation. And I've got Adam Van Zandt that's going to address all the market volatility because guess what? We're seeing more of it. So stay tuned with us as we go through this. And also know that for the rest of the week, discussions on social media, LinkedIn, Twitter, Facebook, our podcast, we're going to be addressing all these topics and keeping you updated using technology in every way that we can. So on that note, Bobby, I'm going to ask you to start off because people are getting concerned. Markets have shown strength throughout the year. Volatility now has picked up. It's year end. Talk to us about possible uncertainties.
Yeah, Greg. So after most equity indexes traded back in November, we are hopeful that December will be a more jolly month for equities, as December is historically a pretty solid month for stocks. So as of now, we're optimistic that stocks will kind of sidestep the new variant, as news over the weekend was overall positive on the fact that the new variant might not be as severe as previous variants. So as always, no guarantee, but historically the S&P 500 has gained 1.5% on average in the month of December, which makes it the third best month behind November and April. So as you can see in this chart, December has been up over 74% of the time, more than any other month. So seasonality can be bullish this time of year, which is important right now with COVID and choppy economic reports causing uncertainty and volatility. But we also know that it's usually the second half of the month where we see the best performance. So we've already seen some volatility in the first few trading days of December. So we're hoping that December continues to be the jolliest month of them all.
Well said. We want everybody to have a great December. And throughout this year with the volatility that we've seen as we continue to move towards year end, people have become concerned. And you brought up some great points there. And Ty, last week, the market traded back some in regards to job reports. Do we need to be taking that seriously? Give us some insight there.
Yeah, thanks, Greg. We're entitled here Inflation Grinch, and the Grinch kind of came out with this headline number of 210,000 jobs. We're expected to have 550,000. So headline number looks bad, but when you dig a little deeper, there's some good news behind it. Civilian employment increased 1.1 million. That's the strongest that we've seen in more than a year. Labor participation rate and unemployment to population are both at recovery highs. And despite all the labor participation rate going up, unemployment is down to 4.2%.
Yeah.
And lastly, average hourly earnings are up 4.8% year over year. Combine that with the hours worked, and worker pay is up 9.4% year over year, even outpacing inflation.
So from the consumer standpoint, they may have some extra money in their pocket to endure the inflation that we may be seeing. And great insight there, Ty. And it really complements what Bobby said. And then Trey, you stepped in and gave some really great insight on inflation. That's as I said earlier, a hot topic with our clients right now. So give us insight in how it relates to what Bobby and Ty were talking about.
Yeah, absolutely. So since this recovery, but even before that, I think the Federal Reserve and the market and individuals have been much more focused on jobs than inflation. It's been decades since we've really had to worry about inflation, and that seems to have those jobs versus inflation seems to have flipped, especially from what the Fed is talking about. And a lot of data comes out on Friday. Core CPI and the headline CPI, its Consumer Price Index, comes out this Friday, and that's important because it's 5 days before the next FOMC meeting. And so the Fed will have time to digest that information before they present the report on how quickly they may be reducing bond buying, which has been very stimulative for the markets. So this jobs data, which may have disappointed in the past, would have been a little bit bullish. We'd have seen stocks pop because that would have meant the Fed may have backed off their easing. Instead, we saw stocks roll over because it appears the Fed is no longer singly focused on jobs. But inflation, while it sounds bad, and especially when you hear numbers like expectations of 6.7%, the highest since 1982, that's got to be bad news. But we're in a very strong position when it comes to corporate America. This chart here I thought was very informative, shows the level of cash in corporate America. It's near record highs and considerably higher than it was last time we were dealing with inflation, which is late 70s, early 80s. So corporate America has a lot bigger cushion where they can absorb some of these price increases. The average American doesn't go out and buy, rebar or steel. They buy stuff that corporate America turns basic goods into. And so there may be some cushion there before it really gets all the way to the consumer, where some of this cost increase could be split. And as long as it doesn't sustain itself for year after year, then we are seeing cash levels go down, but we're far away from where cash levels become concerning.
As somebody in his career who's been through severe inflation, I agree with you. This is nothing compared to what we've seen from a historical perspective.
That's right.
And then, so folks, look, you've heard a lot of fundamental information here as we're tracking it. And then simultaneously, Adam, I want you to address the technical indicators with support, resistance, where this market could possibly go and what we're watching closely. So, and how it relates to the rest of the information provided.
Yep. And I appreciate it, Greg. And like you said, we saw volatility reappear in the markets, the overall markets last week. And
very much so.
We had an S&P 500 close on Friday coming in at 4,538. So giving us a new resistance level of 4,570 and a new support level of 4,510. It's also important to keep in mind, Bobby kind of alluded to it, that December historically seems to be a strong month in the markets. We've seen some evidence of that, of the 200-day moving average of the S&P 500 finally reaching over 4,300, currently sitting at 4,305. So while we've seen this volatility, we've also seen strength in the support level from a long-term standpoint and hope to continue the strength to the end of the year heading into 2022.
As Bobby said earlier in his opening comments there, also the second half of December can be strong. There are no guarantees. Inflation, some of these other reports that are out there have caused more volatility, as you've talked about, but we're watching it closely. So as we move forward, it's hard to believe that here in 19 days, we will have Christmas Day, and shortly thereafter, we enter the 2022 year. We're going to keep you updated through all of this. We hope you find all this information very valuable, and knowing that we're tracking your portfolios in relation to fundamentals and technical analysis, and ultimately in regards to your financial blueprint. You continue to have a great week. We'll be in touch, and we'll talk soon. Thanks.